Hello, everyone. Hi, Don. How are you doing today?
Hi, everyone. Thanks for having me here.
No, thank you so much for joining us. I think it's going to be very exciting. I think we've got a bunch of things on. Let's actually tell the audience what we have for them in store today, shall we?
Yes. So today, thanks everyone for coming. For taking your time on a Thursday night to spend your evening with us on learning about REITs. There's been a lot of talk about the REIT space recently. 2019 was a really good year, and I think anyone who invested in REITs back then have and if you cash out, good for you. If you didn't, not to worry, there's still lots of room to go. But yeah, there's been a lot of talk about REITs in recent months because with the lockdowns and with all the tenants having issues. So there's a lot of people who are worried about what the future of REITs might be like. And today in this webinar, we're going to talk about investing in REITs as an asset class, why there's a compelling case to be had, and whether REITs are dead or are they still very much alive. And then we'll also talk about what are the different ways you can actually invest in REIT with a focus on how Syfe can actually help you to do that better and much more passively while still having very low cost. So we're gonna jump into that, and we're streaming this live on Facebook as well. So if you have any questions, please go ahead and either key in your questions in the Q&A for those of you who are joining us on Zoom. Otherwise, go ahead and leave us a message, leave a comment on the Facebook live video, and we'll address them as well. Yeah, over to you, Drew.
No, thank you so much. Thank you so much, Don. I'm just really excited. I think we've done, the way how I've realized, by doing some of these webinars over the last few months, it's always much more fun when it's a bit more of a conversation, I guess, between us as panelists rather than slides. So historically, for some of you who might have come maybe for a previous, I guess, either an offline or an online, webinar, we normally do have a lot of slides. But today, I think me and actually it was Don's idea. I'll give a credit for that. We thought we will actually keep it a bit more interactional. So what we'll do is we will probably try to go ahead and present maybe about like just 5 or 10 slides, give you a very quick overview, and then we obviously have a whole arsenal of slides should you have any more questions. But I guess the point from there on becomes is that we keep it interactive, right? And we will be here to answer all your questions. So keep them coming, and we'll address them, right? So without much ado, I'll pass it back to you, Don, to just give a quick overview of what's been happening in the space, at least in terms of relief measures which have been coming, both I guess for the landlords as well as for the S-REITs in general.
Yeah, so I think there has been lots of changes in the REIT space in recent months, and then even more recently, just a couple of days ago, right? And we've seen that MES has basically increased the leverage limits. Previously, I think once upon a time it was like 30 or 35%, and then it became about 40 or 45, and now it's at 50%. MES has also deferred the new minimum for the interest coverage ratio. And basically, I think one thing that every investor should be aware of is that we have seen some REITs start to cut dividends. There might be some who might be halting it. We don't know at this moment, but they have now a longer time frame to actually work with that. So in Singapore's context, REITs actually have to distribute 90% of their distributable income back to the investors. But with the recent relief measures that are basically there to help those in real estate, actually not just the REITs, right? There's also those in those of us who are landlords, or if you're in SMEs, this also there are different regulations that apply accordingly. But specifically in the REIT space, the distribution payouts may have a longer time frame now. So it's been pushed back from originally what was supposed to be 3 months to now 12 months. So that gives REITs a lot more breathing space to help them go through this period of liquidity issues that they might have with tenants not being able to operate. So yeah, I think these are really great measures, and it's quite timely also because the sentiment has changed very much over the past few days, hasn't it? It was so negative. Like I think about a few months and up to last week, the sentiment was actually really negative, right? And people were saying REITs are dead. Now that work from home is the new norm, office REITs are officially dead. Companies are no longer will see that there's no need to pay rent. They can just have employees work remotely and retail is dead because
Yeah.
no one's gonna go to the malls because of the virus. So yeah, and yesterday then the markets rallied so much with the reopening, and it really took me by surprise. I wasn't expecting such a sharp rise in REIT. So in just a short time, we've seen how the sentiment has changed so much. But that's why, we also emphasize that at the end of the day, fundamentally, are REITs still a great investment asset class? The answer is most likely, yeah. I would be inclined to say yes, because all of these sentiments would change every now and then, right? You're going to have poor sentiment, you're going to have optimistic sentiment. But at the end of the day, the fundamentals of REITs as itself, of real estates in Singapore, does not change that much. So I still think that's a very strong bullish case to be had for REITs.
Yeah, in fact, I was just looking at some numbers earlier today. I don't know if you have an estimate. So a lot of you may raise a very good point about office REITs, right? And that was one area where everyone thought, oh, this is dead and this is done. I was just looking. So do you know how much down for the year are the office REITs in Singapore? What's your estimate? Do you have a rough estimate?
Oh, I haven't checked actually, but I know some REITs went down by like 50% when I was monitoring them.
Right, exactly. So that's what even I remember. I was just checking as a sector as of, today afternoon, the office REITs for the year are only down 7%. And at one point, this number was almost close to 25, 30 odd percent, right? So of course, the point of recovery is happening. And I think there are a bunch of reasons. I think something, we can definitely talk a bit more about. Great. Thanks for, that quick intro, Don. Let me, actually get on and, get a quick overview of basically, REITs market. I think some of the things, obviously, Don alluded to. I think some of the key points, and I think one of the reasons why we also think it's a great tool generally, for a passive income is the fact that they're supposed to pay away the 90%, of their profits as dividends, right? As you know, they're tax efficient. There's no taxation liability, especially either if you're an individual or even if you're a Singapore, based corporation. And they are actually traded on, stock exchange. They are liquid. So, in some ways, a lot of people, think REITs, and to a fair extent, for good reason, as a proxy to actually, ownership of property, right? Sometimes we say it's probably like being like a hassle-free landlord, and your rental payment is the kind of dividend that you get, right? Also, interestingly, as we're talking, REITs obviously have many of their subsectors, right? So, we spoke about the office sector or the hospitality sector, but, you would have seen, in fact, some of the sectors, and I was just looking on my other screen right now, such as, healthcare or even some of the, industrialized REITs, they're actually up on the year, right? Which actually says that, the beauty of a sector is that it is diversified across, various subsectors, right? So that's actually one very, a high level overview of REITs, as some of you might know, right? And I think also Singapore becomes very interesting because, Singapore is the largest, market in Asia after Japan. 25, and I think on some days, even 30% of the market turnover is REITs. That's how, popular, this is, right? And I guess, the dividend aspect is something which is very attractive. The dividend, is north of the 5% range. But what is also important is, as a sector overall, this is a huge sector. I think last I checked, despite the correction, it is still more than $100 billion, right? So it's extremely liquid. So very easy for people to come in and go out, right? So if you want to have, how do I say, a quick view on a particular sector or a subsector on the real estate, I think REITs become a great proxy to it, right? And I think, again, getting in, getting out, sizes, it's much more easier in a way versus, let's say, of course, getting physical property. Of course, it has its pros and cons, as always. Right. And of course, again, as you mentioned, right, I think all the good points, it's all out there. I think the only, I guess, the negative and the red little point that I will, try to highlight is that there is, this kind of a concentration risk which happens because at the end of the day, we obviously believe in diversification. I think REITs themselves are good, if at least as a broader sector, because what you saw, especially in this time, was even if though, your, let's say, hospitality REITs did not do very well, your industrial and your, healthcare REITs did well, right? So I think there's a little bit of a subsector diversification. However, it is after all one asset class as real estate, right? Something to be mindful of as we actually get onto it.
Yeah, definitely.
Yeah, great. Yeah. So Don, do you want to how this whole interaction started was you started doing your own independent research and found some differences, and I think you had summarized them on a very good a very good post which I remember seeing over the internet. So you want to get in and say like what your views are on the multiple approaches, the DIY, a regular ETF, or a Syfe REIT plus. Yeah. So.
Yeah, definitely. So I'm going to come out upfront and address like the most important question that most of you guys are going to probably have, which is basically how on earth do I invest in REITs, right? And if you're a retail investor, generally you can choose from 3 different options. So the first one is to DIY, to do it by yourself. So that's where you get to select and cherry pick the kind of REITs that you think are the best quality, whether or not you think certain themes or certain industries would do better. So for example, if you're really bearish about the state of office REITs in the longer term, because you really feel that work from home is going to kill off the case for long-term office REITs, then that's fine. You could choose to invest more in, for example, the healthcare REITs or even data center REITs, which has been really popular and resilient during this coronavirus outbreak. So in this case, the pros and cons of DIY is that you get to pick the ones that you like, right? No one's going to tell you you have to buy something that you're not interested in. You really get to only choose the ones that you like. And in this case though, what you do need to know is that if you do the DIY method, the quality of your selection is going to be there, but please make sure that you are equipped with the right skills and you're going to put in that time and effort to monitor your investments, to do your homework, to do your due diligence, and to really keep up with what's happening. So I'll use, for instance, First REIT, right? It's the REIT. It's in the healthcare sector. It has done pretty well. In fact, it was one of the best REIT investments for many investors who got in much earlier on, until things started changing in the last year or the last 1.5 years, right? And First REIT had a major crash in its share price fairly recently because of issues on the sponsor side. And if you were not monitoring that, you might not have been able to get out of it in time. And for all we know, there might still be some people who were invested in First REITs who are still holding on to that and are not even aware that this happened. So if that's the case, then you have to really be able to do your homework, monitor, and move in and out. And as you do that each time, you're going to incur buy or sell transaction fees that you need to pay to your brokerages. Now, of course, the good thing is since you're the one managing your investment by yourself, you don't have to pay any management fees at all. And in terms of your investment capital, this depends on what REITs you're going to buy, because there are some, basically the minimum lot size in Singapore is about 100 shares, right? So if you buy REITs that are under $1, your overall size of minimum investment is going to be smaller than if you buy a REIT that is that is trading at a much higher stock price. So your investment capital may not be that low. There's almost no way you can start with $100 after factoring in 100 shares plus your buy or sell transaction fees and everything else. It's actually not even worth it to buy one REIT for that low amount of money, right? Considering how much your brokerage cost will set you back alone. So I personally, I have to say that I'm largely an investor. So I do a lot of stock selection and I spend hours and hours researching and monitoring the stocks that I'm interested in. So I'm a huge advocate of the DIY approach. But as we move on to different stages of our life, you start to have less time. So for those of you who might be more interested in, you want to be focusing more on your career, or maybe you have a side hustle that you want to spend more time on, or maybe you have children and you want to spend time with them, with family, and you just don't have that much time to go and do all that research. So then the DIY method may not be the best or most efficient use of your time in that sense. Okay, so it's a great approach, but at the end of the day, remember, in investing, it's the approach that fits into your context, your lifestyle, and your schedule, your risk appetite that will work the best. So there's no one above all method. So that's for the DIY. And in terms of the second method, which is you could then opt to go for a REIT ETF. And we're pretty lucky because I think if you turn back the clock to several years ago, there wasn't much selection for retail investors like us to choose from when it came to such exchange traded funds, right? And then, your different competitors started coming up. So you have Lion Phillips coming up to offer it and a few others. And there are a couple of options now that you can choose for REIT ETF, all of which have a different premise. Now, I think the REIT ETF is basically like a basket of REIT stocks that they basically put into one ticker that you can buy and trade. And because you don't have to essentially pay the buy sell transaction fee for the individual REIT components in the ETF. because you buy one ETF and you immediately get exposure to multiple REITs. So it's a great way to get instant diversification, and different ETFs have different themes or different niche, unique focus that they're offering. So you might want to read up a bit more about that in order to help you decide which REIT ETF might be the better choice for you. Now, in terms of low management fees, they're definitely reasonably low. Investment capital, because you can get instant diversification to more than just one REIT at once, it is definitely a lot cheaper than if you try to replicate that in the DIY approach. And the great thing about ETFs is that they also automatically subscribe to rights for you, so you don't have to go to the ATM or go online and click yes, I want to subscribe. It's basically done automatically. But most of the ETFs, and this is one thing that some investors have said already, like we wish that they could help to reinvest dividends, because when you reinvest that, you allow that to compound and earn even more for you over time. So that's why I think this is really unique, and I really appreciate that you guys invited me to collaborate on this together, because that when I started looking into the Syfe REIT Plus, I was not the most convinced at first glance. Right? I have to say at first glance. But then as I really started going into an in-depth comparison, and I think I spent like almost one day comparing it with all the different approaches, because I really wanted to make sure that this was a good method before I start doing it myself or recommending it to my friends or readers. And I thought this was really interesting because how you guys have designed it is you follow the SGXI index, and that's something that the SGX site handles. So yes, that's the same downside as with an ETF. You don't get to choose your own REITs, but that could also be a good thing for some others who basically don't know how to pick your own REITs, right? Yeah. Because imagine if you had picked like First REIT or Eagle Hospitality Trust, which was a really sad story. So I actually got burned on that because it was supposed to be a short-term trade. And then you see, I let my mistake get to me because I didn't have time. So when I went into it, I had time. But then when the whole saga happened, I was really busy at work. I didn't have time to monitor, and I thought I put in the sell order, but apparently it didn't go through, and I forgot to put in again next day. So it was a really, really stupid mistake. And if you don't have time, so this is where I think really, if you don't have time and energy or the resources to keep monitoring this, right, then sometimes going for something that's a bit more automatic that enforces that discipline for you would be a better approach, because you wouldn't be caught on the wrong end of the stick. And I think what you guys have done really well, what I like about Syfe REIT is that, again, there's no buy-sell transaction fee similar to the ETF. But I think what really, really stands out from the ETF approach is that you guys reinvest the dividends. So I love that you guys added in. Maybe if you could share what was what was the thought process you went through when you decided to design this for us?
No, so we actually spent quite some time, right? I mean, what we do is that we have a global product which we launched with last year, and even for that we almost spent a year of user testing, talking to users, trying to see what users really want. And one of the big grievances that a lot of people came with REITs was that they like it, but it just became really expensive to trade, right? Just even if you had to trade it yourself, or even if you're trading through the ETF, it becomes very expensive because you have to pay heavy brokerage charges, right? So let's say even if you're buying, I don't know, like $200 of a particular ETF, you have to pay $10, right, in brokerage charge one way. That's like 5% gone. That's huge, right? So anyone who's like systematically investing or putting over time, I think it doesn't make sense. The other thing is the dividend reinvesting actually was a very big ask, because let's say even if you invested $100,000, when you get dividend, you might get a dividend on one of the REITs which might be $100. You really can't invest it because you will not invest it because you have to pay $10 to invest it. So that's like 10% gone, right? So that's why we allow our systems and all allow to actually reinvest dividends. And I'll give you one very interesting statistic. What we have run these numbers, if you reinvest all your dividends, you end up getting 0.5% on average every year extra, right? Which is great because just the ability to reinvest dividend in a way pays up for your, all your management fees in a way, right? So if you're a black customer at Syfe who's paying, 50 basis points, it just pays for itself, right? And I think that's a very, very powerful tool that people don't really, they don't think of it that way. I'm glad you picked on that point, but it's a very, very significant, point.
Yeah, exactly. So I think that's where this portfolio really stands out. But we don't want to make it all about the Syfe REIT, right? So we're going to talk in today's session. We're going to address like the general trends of the REIT industry, and then of course, you know, with Dhruv here, you guys can go ahead and ask any questions that you have on the Syfe REIT, because I'm sure those of you who are keen on this approach are definitely going to have questions. And yeah, we can talk about, like, you know, I thought it was quite interesting the way you guys do the ARI and how you offer two options for some investors. I would definitely go for like the 100% REIT option, right? But my risk appetite is very different.
You're a risk taker.
No, but that's only because I have the bond selection already catered in my own portfolio.
Right.
Yeah, correct.
Okay, great. Yeah, I think we should, why don't we take a small break, and I think I can see a lot of questions flowing in. So I'm wondering if Sebastian wants to, chime in and, show us himself. Hello, Sebastian. Welcome. You've been silently snooping on our conversation, is it?
Yes. Hi, Dhruv. Hi, Don.
Hi.
Very interesting seminar so far, and we have also already gotten quite a few questions. And I want to go right into it and start with the first one, which is James is asking, what is the ideal proportion of a portfolio that should be allocated to REITs? I think to both of you.
Yeah. Don, do you want to go first and pick that up?
Yeah, sure. There's no ideal. So I'll be very honest, if you're looking for like a percentage that you can immediately go and apply, right? You're not gonna get that, because at the end of the day, it boils down to your own asset allocation and your investment portfolio objectives. So you actually have to look at what is in your portfolio, and because REITs are after all one asset class. Right. So let me give an example. If you have multiple real estate properties, so you're literally an owner of several properties, or you're a landlord for that, then if you were to go let's say 50% of your entire investment portfolio into REITs, that's actually a really heavy weightage on the real estate sector itself. And if anything were to happen, I mean, we don't have earthquakes here, so that's great. But, if anything were to happen that could affect real estate value, then you're going to get hit from both sides, right? So that wouldn't be ideal. But to someone else who does not have real estate, then, 50% might still be okay, maybe 40% or 30%. So the question is, what are you allocating your funds to for the rest of the portion? And then from there, you have to seek out your own balance. If you're super bullish on real estate, then I think, anywhere from like 25%. If you follow the permanent portfolio methodology, you could try with 25%. If not, if you're super bullish about real estate and you think that, stocks are a scam or anything else doesn't have that kind of reassurance, like the older generation, they were super bullish on real estate because it paid off so well for them, right? And if you fall into that camp, then maybe to you would be going for a higher allocation. But yeah, the short answer is there is no ideal. You have to come up with what is ideal for you. There's no shortcut for that.
Yeah,
there's only one thing which I could add is like at Syfe we also offer advisory service. So for everyone who wants to look into their individual situation, feel free to get in touch with one of our advisors, which you can do right through our website. And they will help you to look into your individual situation and figure out what is the right allocation for you.
Yeah.
Let's continue right away. And Isabel is asking, as you mentioned earlier, like there's a huge bull run in the last like couple of weeks actually already. And she's asking like, how much further can it actually go? Especially as some of them, and she refers to Ascendas, is already higher than before the COVID pandemic. So yeah, maybe I think this is a question for you, Dawn, as you're the more active investor.
Because I'm the one who does active selections, right? Okay, I haven't looked at Ascendas in recent weeks, but I think it is easy to say that it's a huge bull run now, because at the end of the day we only have the current time frame to look at. But if you were to take a further step back and you look at a longer time frame, right, on the left side of the chart, which is basically everything that has already happened to date, maybe that have gone up high, but high can also go higher, That's something that investing has taught me. It doesn't mean that just because it has gone up by, let's say, 30% or it has doubled, that it cannot grow. I mean, seriously, look at REITs like Parkway. One of the best performing REITs. It's just been going higher and higher and higher, right? Or look at, for example, Keppel DC REIT. It's been going higher. You would think that, wow, it's gone up so high already. And then you're like, okay, I think that there's like no more room to run. But no, that's not the case, because what would cause REITs to go up higher is basically the growth. You know, there's a lot of factors that you have to look at. There's like, you know, the occupancy rate, the quality of the assets that they own, whether they're doing AEI to transform and make better use of that space. And then also, who are their competitors? How are they standing out against them? Are their rates for tenants competitive? There's a lot of things that you have to look at. So that's the qualitative and competitive analysis. So I'll be honest, it's not something that you can find an answer to straight away. So that's why, you know, if you're a DIY, I'll tell you, I love the whole process, right? I enjoy it. But if you don't have time to go and individually analyze each of these REITs, then maybe that's why Syfe is a good option, because you don't have to worry too much about those. And yeah, REITs have gone up, they can still go up higher. It doesn't mean that the bull case for them is over.
Great, thank you, Dawn. Another question which I think is relatively quick to answer is, do you know if there's any other REITs which will be listed this year?
I wish I did. I was just reading the news about Far East, right? I think that's going to happen in Hong Kong rather than Singapore. So we don't know. I mean, we have to ask SGX. So if anyone from SGX is here, please give us a hot tip.
Yes.
The good thing is that because we do track the SGX index, so if it gets listed on the SGX, we will have exposure to it, right? So
Yeah.
Exactly. So to give Dawn a little bit of time to have a sip of water, Dhruv, questions for you. One, is First REITs part of the Syfe REIT Plus portfolio? And I want to combine it with a second question, which is like, can I also opt for REIT Plus if I don't want to reinvest the dividends?
yeah, sure. So First is currently not a part of the universe, but you know the way how we decide is, and I probably should maybe I think probably I should share my screen again if you give me 1 second. I can tell you how we actually end up choosing our EDH. Just give me 1 second, people. Right, there we go, and share screen. Great. So actually, right. You guys see my screen now?
No, that was not here, but yes, correct.
Okay, great. So what we actually do, right, and maybe I'll just tell you is that like when we decide to build our index, right, we're actually trying to track the iEdge SG REIT 20, which I think is a great benchmark and a great proxy. And Syfe currently is the only, I think, publicly available product which can actually allow access to this index, right? So what we do is we have to take the 20, of the most popular REITs, which end up, building based on the criteria that SGX has, right, as the indexing team, right? And essentially, some of these are some of the aspects, right? We basically essentially look, that they should have, high free float, velocity. They have a 10% minimum cap, but also, essentially high quality fund managers and so on and so forth. So as a procedure, this is something which actually constantly, keeps on evolving and keeps on, improving. But currently, it's not a part of the setup. And if it does get added by the index providers, we will actually be the first ones to know because we are officially licensed and we will update our index as well. Your second question, that's a good question, right? I'm a very big believer of what Dawn just said. If you don't need the money, reinvest it, right? That's the best thing you can do. But for some people, we can see how this is a passive income stream where they look to get some passive income out of it. So for customers who have invested north of $20,000 with us, they can actually opt for a payout feature where every quarter they get paid out the dividends that were earned in that quarter, right? And the reason why we put a $20,000 minimum is that, otherwise the dividend values are not very significant. So typically, let's say if you get even 5% dividend in a year, roughly you get, let's say 1.5%, in a particular quarter. Even on $20,000, that's just about $200, right? So to make the transactions meaningful, both for us and for you to process, you have a payout option which is given to customers who have over a black option number.
Mm-hmm.
Okay, thank you for this answer. There's another question which goes a bit into detail about the different sectors. And the question basically is, right now the sectors which are doing really well is like telecommunication and so on. What about residential and office REITs? Do you see that there is room for them to innovate and find new ways to come back? Or how do you see the situation for them?
Yeah, I mean, I'm happy to take it, right? I feel like actually this is going to be quite interesting, right? I think one of the things I personally like a lot about, uh, I guess, the Singapore real estate market is that we are still like, I mean, I know we keep on reclaiming land, but by and large, it's a bit of a supply demand, mismatch in some ways, right? There is limited things to, there's limited land around, let's put it in many ways, right? So something very interesting that some of you might associate. I was reading this, in this global report in the US, when some of the office sector demand in Philadelphia actually went down, Amazon actually ended up making some of those offices as fulfillment centers for their quick, 30-minute delivery model, right? So I believe that given, we are in a relatively, an area, especially, the prime areas, etc., where land is actually a bit limited, I think the innovation will happen. And I've always, and this is a very, very extreme stance, and I don't say this is going to happen in the next maybe 1 or 2 years. But let's say if there's a consistent shift of everyone's working from home and this is the new normal, so on and so forth, well, I guess people will want bigger homes, they will want better homes, and so on and so forth, right? If that's the case, there is nothing which stops technically and so-called office REIT to reinvent itself. Yes, this is not as simple as, put on a new makeup and it's done. It's of course a very significant transition. But again, I'm talking of, this is a sustained behavior for 5 or 10 years, right? So my short view is that there is 100%, there is room to innovate. And we have seen this happen before. We have seen, shop houses becoming, more shops than houses, right? So houses different in some of the sectors, right? But I'd love to get your view on this, Don. What do you think?
Yeah, I'll address this from 2 points. So one would be the sectorial change itself. I think that's for sure. I agree with whatever you said. It's actually really exciting because I think we're literally watching history happen, and it's gonna be fun to see how the REITs are going to adapt to it. So I think offices, there are many models that could work in the future, right? And one of the ideas that I've been actually discussing with my friends is that, maybe there will be a rise of more short-term offices, where you basically just like go in, maybe you just pay to book a place for a few hours and that's it. You don't have to be in permanently, right? And I think with Facebook, Mark Zuckerberg going out there and just saying they're going to officially have remote working now, then if other companies follow suit, that is going to definitely affect the office REITs, especially those listed in Singapore. But, then which brings me to my second point. I don't think the REIT managers are just going to sit around and let them happen.
Yeah.
Right.
Exactly.
So if the sector really changes so much, they have to innovate, and that might be acquiring other assets or maybe even merging. So I think Far East had a merger recently as well. Right, F-Corp, because I was affected. I was a shareholder in one of it, and then they merged, and I got the letters and all. So they merged, and they went from being like pretty small individually to I think being like number 8 in size of the whole S-REIT market. So that was a pretty significant move. And then we also had ESR, right? So they acquired Viva and I can't remember which one. So then that formed ESR. And I think if really office REITs are like kind of dead and they're not being lucrative, they're not generating enough for the REIT managers, the REIT managers have to find another way to get in those revenues or risk having stakeholders sell off their investments. So then they might be merging with maybe, residential, hospitality, retail, I don't know. So we're going to start to see changes for sure, but that's where we'll have to monitor. I think that's exciting. But I think, that's the thing. If you invest in a basket of it, right, like through the iEdge S-REIT index, you wouldn't be too concerned. But if you invest individually, this is going to affect you majorly. You have to make sure you're following all the news and everything that REIT managers are saying and doing. Otherwise, we all know what could happen if you don't.
In many parts, I was thinking, Don, like if you look in many parts of the world, right, a lot of like somewhat semi-residential areas end up becoming commercial areas as, need increased, right? And, again, he said like from okay, initially it's just the ground floor is a shop and, above is a house and then everything is a shop, right? So I think, there was one shift which actually largely saw residential somewhere getting converted to commercial as need for commercial actually increased. And, as economies, need for offices and, desks and all increased for physical space. And, as I said, right, I mean, nothing really stops, to your point, for there being another kind of a shift, right, where they innovate and something else happens. In fact, somebody else I was speaking to the other day, they said, though, like the big banks, which are some of the biggest landlords, some of the biggest tenants in Singapore, right? Though even if they implement, a 50% work from home policy, just with the safe distancing measures and how they are designed, they'll probably still need to keep the same amount of area, right? Just to ensure that everyone can still come and, function efficiently. So I think it'll be interesting to see how that pans out.
Yeah, exactly. So yeah, let's watch and see.
Yes. And there are more and more questions coming in. Let me pick this one here. And there is one of our viewers asking, why are there costs related to buying ETF, but there are no costs when investing in a Syfe portfolio? Can you please elaborate a little bit on why this is the case?
Yeah, probably makes sense if I'll take it. So yeah, so when you really go and buy an ETF, right, you actually pay multiple layers of charges, right? So firstly, of course, you're paying the ETF manager their management fee, but eventually you're trading a stock in the market. So you have to pay like your brokerage and the other charges associated. Sometimes if you're using some platforms, they even have a platform fee attached to it. And so on and so forth. So there are a bunch of these charges which get added just to the actual management fee of the ETF, right? Biggest one being platform and brokerage charges. Because actually with Syfe, it's encompassing everything, and we use technology to keep our costs extremely low. You don't actually end up paying for brokerage or platform or other charges, right? So you can trade in, trade out. We don't recommend active trading. There's no value in it. Trust me, I've been a trader for over a decade and a half, and it's never paid up for me. The whole stay invested approach probably works the best. But the advantage is because we actually absorb those brokerage and those custody charges within your management fee itself. It ends up being significantly cheaper if you're normally investing. And as I said, with reinvesting, it is actually, you really can't do it with brokers, because what you will pay is much more than normally your dividend, right? Whereas in our case, it's done as part of the regular management fee, so it's much more cost effective.
Great. And then another question for Dhruv. Can you share how RE works? Because one attendee is asking, currently the proportion is about 50-50 between ABF bond and REITs. Can you maybe elaborate a little bit on how we decide this allocation?
Sure, yeah. So let me say, like, actually, what are the two options that we have between, our options, right? So one is the 100%, REIT portfolio, which is for risk takers like Don, right? Who believes in the sector, who believes long term, and so on and so forth, right? But again, as Don mentioned, actually, it's very important, because if you have your own strategies for, the relatively safer assets like bonds, for example, or fixed deposit, or other tools, then it makes a lot of sense, right? So that's the 100% REIT. How RE actually works. So the premise of RE stands for automated, risk managed investing. What we do is that in volatile markets, we actually decrease the composition of REITs and replace it with bonds. So what that means is that you can start maybe with 100% REITs, but if you choose, optimize with RE, when markets go volatile, we will decrease REITs and we will increase bonds. Now there is a lower floor of 50% on REITs. So we will not go below 50%. If for some reason markets move, it belows 50%, we will bring it back to 50%. But the key point is out here that what decides us to decrease the allocation of REITs and bonds is completely based on the risk of your portfolio. And this is not a view that myself or, we have a very qualified or very well experienced investment team take. This is purely in the numbers. We actually compute, it's possible to compute what's the risk of your portfolio. And if we see the risk of your portfolio is more than 15%, i.e. it can correct more than 15%, we will actually, rebalance it to this number. So let me tell you how it really works in action, right? And I think you might want to be interested to see how we actually performed in action, right? So these are two examples, right? Where if you had taken a SG REIT index and, and basically, the REIT plus, which was basically with risk balancing. So the REIT plus actually is the golden line and the blue is the index, right? The red marks identify the points when we rebalanced. These are instances where we realized, where we identified, because we run these tests every day, every portfolio, every day this is run. When we identified that the risk of your portfolio is high, we actually sold, REITs and bought bonds. So you can see on the top right, we actually reduced the allocation of REITs from 77, down to about 50%. Actually, REIT markets continued correcting. So that 50 actually became, close to 45%. But because we have a 45 or 50% floor, we actually increased the allocation of REITs, right? So if you are someone who is managing, like Don, your passive, how do I say, your safer, completely safer assets like bonds, etc., on your own, then I think 300 makes sense. Otherwise, by RE, we will actually balance this amount and we will bring it down. Our goal is to ensure that we manage the risk of your portfolio. And that is actually the premise, what we do for our global strategy as well. I know today's session is more about REIT, but that is something, if you want, you should join one of our subsequent seminars on how we work with RE, and we'd be happy to deep dive into that.
Great. Thank you. There is one topic which came up now 2 or 3 times, and I think it's also something which is fair to answer, which is what would happen in case Syfe stops operating, and what would happen to my funds?
Yeah, so actually, we to just get our license in Singapore, we almost took 1.5 years, and that's because I think there are very few providers who actually have a CMS license for fund management. Now, just to give you a premise, to get a CMS license, you have to have extremely high thresholds. You need a base capital, which is, just safeguarded north of $1 million. You need extremely proficient team, MS came, they met the team, they saw the pedigree of the team. But besides that, there are a lot of regular, bells and whistles which we have to keep in place. So for example, we are audited by a Big Four. We have internal audit as well. We have external compliance. We have a full-time internal compliance as a professional indemnity insurance. So we have all these checks and bells in place. So there is no abrupt action that causes, Syfe to collapse, right? What's more important is that in the remote case, right? And of course, as a founder, it's obviously very hard to think of those cases, but I understand this is money involved and this is, your hard-earned wealth. In the remote case that, Syfe does stop operating, typically because they have the indemnity insurance as well as the base capital, this is not something which happens overnight. This is a process which happens over, weeks and months, right? What MAS will typically do is it will have 2 approaches. It will either assign another fund manager to take our accounts like yourself and manage, on our behalf, essentially. Also, they become your fund manager, or alternatively, and this is completely up to your choice, you can actually sell and unwind your assets, right? You can basically sell your assets right there and then, and you can completely unwind. So it's not going to be like, oh, Syfe goes out of business, tomorrow morning you wake up, it's out of business and your money's gone. No. Also, what's very important to know is when you trade with Syfe, all your assets are actually kept in a trust account. So when you move the funds, you're actually not moving it to Syfe. In fact, our bank and our corporate account is completely separate. You're moving it to a trust account at DBS, which is only and only client funds. And from there, it moves to a client account, at our broker Saxo, who's custodies for the HSBC and Citi. So in a nutshell, like your assets are away from, the Syfe ecosystem. And in a way, we can't really act on them because they actually belong to our end clients like yourself, right? So there's a safeguard in how the custody is structured for the assets. But even if there's a remote case of Syfe shutting down, there's a systematic procedure for either allocating another fund manager, or obviously you having the option to unwind at market prices at no loss per se.
Yeah. Dhruv, maybe if you could share on if so someone is asking, is there a chance that they can keep the assets instead of having to liquidate that?
Yeah, so I think, given the scale that we have achieved in a relatively quick time, there'll be a lot of fund managers who will be happy to take our business. So when they do, your assets will actually end up remaining, with that fund manager. the way how it is structured, if your question is, can you move it to your personal account? Not directly, you'll have to probably unwind and then go and buy through your broker or the setup and all that. But typically, the case is typically if a fund manager takeover, in that case, your assets actually anyway do remain.
Great. Thank you for these answers. Don, maybe it would be interesting to get your perspective on what do you think is the impact on REITs if Singapore will have negative interest rates?
I think it's going to benefit REITs, right? Because, when you have negative interest rate, two things are going to happen. First of all, the banks are going to start cutting interest rates even further. So there's less and less of a premise to leave your money in the banks. Your endowment funds are probably going to start offering you even lesser as well. So overall, as the yield environment for other type of products or other financial services drop, then people are going to start flocking to other places where there is high yield, right? And that could actually benefit REITs because they have a very solid track record and they are essentially mandated to pay out 90%. So if that doesn't change, then it should actually benefit them in terms of the investment capital flow. Now, the second part is that in terms of interest rate, so REITs, as you guys should know, if you're not even relatively new to REITs, please note that REITs are at the end of the day a kind of leveraged asset. Okay, so they are allowed right now to gear up to 50%. Yeah, some people are not comfortable with that, but that's basically the REIT universe. Previously it used to be 30%, and we don't know what it will be for the norm after this whole coronavirus and economic situation is behind us. But generally, they are pretty leveraged in that sense. Not super high leverage, not super high risk, but just know that they are to a certain extent. And as a result, right, if negative interest rates happen, it's going to benefit them because they can actually borrow more. So they could then borrow more and use the capital that has been raised, provided that they still have room in their gearing limit to raise those funds to actually go and purchase other real estate assets. And that will add on to their net asset valuation, the NAV. Then the P-NAV ratio, the price to NAV valuation, would also react positively. So that, and then logically speaking, that would lead to a rise in share price. Of course, I'm not going to factor in sentiments yet because no one can control psychology and sentiment. But in that space, when you look at it from a more quantitative, from a more macro aspect of things, that is likely to actually benefit REITs. Yeah, it's more of if the interest rate goes the other way, if they go up, then you should be worried, right? And I think that was the case in, was it 2018? Sometimes my investing journey makes confusing, right? Because there's so many years of memorable events. But I think
Fed just kept on increasing rates for the longest time, right? And when US rates, it comes down up to Singapore. And actually, this actually brings me to a very good point, right? I remember I was a younger trader at UBS when 2008 happened. I actually, it was the first time I got introduced to the world of ETFs, and eventually ended up, running the distribution desk at UBS for ETFs. And I realized that is the power of diversification, right? Because unless you are a very astute investor who is in the weeds and understands the deep down details and is on board calls and shareholder meetings and all that, there's always possibility that one particular bad apple might emerge, right? And that's why by getting, I think the point that even you alluded to earlier, Don, which I completely agree, building a diversified thing is Ritesh, who runs advisory for us, when he goes on these advisory meetings, he says that diversification is the only free lunch in town. And to be honest, that is true, right? Just like diversifying away, you avoid the risks like, what we've seen with the illegal cases and all, in recent times and all that, right? So even we don't want it. And of course, given the fact that we are building with SGX, they have a really savvy team, which I think they are probably know much more about the REITs, than sometimes even we do. So originally when we were thinking about it, you asked us earlier, Don, originally we were thinking that we'll end up picking the REITs and we will choose because we are fairly qualified people, combined experience of north of 100 years, worked at all the big banks and, build these things out. But, we also realized we should leave the expertise to the experts, right? And we just feel much more comfortable. So what I gather is they're also coming up with some really interesting changes in the next 4 or 5 months. And when they come, we'll be at the forefront of that changes for our users as well.
Sounds exciting. I actually wanted to also jump in and contribute one question. So this hasn't been asked in today's, I don't see it in the Q&A yet, but it's something that my friend asked previously. And I think this might be something that others would also be interested in. So, some people would then compare Syfe to other robo-advisors, right?
Yeah.
And I think, like, first of all, I'll just say that comparison may not exactly be accurate because each robo-advisor has a different approach and a different portfolio that they offer. So if you look for an equivalent Syfe REIT plus competitor, I don't think there's any in the market, to be
I don't think
fair.
there's any REIT product in the market, right? I don't think any of
Yeah.
these players like actually even have a REIT offering right now, right? So.
Exactly. So the portfolios for the other robos are very different. So it shouldn't be a robo comparison. But anyway, there will still be some people who would make that comparison for sure, because maybe they have a sum of money and they're thinking which robo to invest in. So if that comes down to it, right, there are some robo advisors who choose not to commingle their investment funds. And for some investors, that seems to be an important thing. For some others, they feel it's not so much important because of the pros and cons. Maybe if you could share a little bit more on why you guys decided to structure yours accordingly, and why there isn't commingling here.
Yeah, it's a great question. Yeah. And I think it alludes to some of the points that you mentioned earlier. I think the problem that see, if you think of it, right, and I think you mentioned earlier also, technically when you invest in ETFs, they are commingled one way or the other, right? And the reason why they can do something, I think generally ETFs are a great tool. I don't think the REIT ETF in Singapore is a great tool. ETFs generally are a great tool. I think for REITs, I think we know why Syfe REIT is the best. But the reason why commingling sometimes happens is to actually bring efficiencies of scale. So I'll give you an example. Let's say if you want to invest $100, and some of you might want to put $100 into this portfolio, right? What you actually need to buy is $10 worth of Ascendes and $5 of Capital Mall and $3 of Capital DC, right? It's impossible to buy it. So actually just replicate this index, right? You will need close to $25,000 to $30,000 at least to replicate exactly the index. That's the first part. The second and very interesting part becomes the capability to reinvest dividends, right? When you are reinvesting dividends, right, then on that accord, the concern which happens is that because even if, as I mentioned earlier, even if you have $100,000 in REITs, the dividend might just be $100, which is actually a reasonable dividend to receive, right? If you think of it, what are you going to do with $100? You really can't invest it out. So the only way you can do it is to actually fractionalize it and allow small portions and then combine these small fractions together. And that is the reason why we chose this approach. So the key reason of this approach, choosing of this approach, was that it will allow us to do things like reinvest and so on and so forth, which otherwise you just can't. It's just not possible, because if you have individualized assets, even if you have $100,000 invested, you can't do it. I think we were reading the numbers. If you really want to have a successful dividend strategy of self-reinvesting, you need north of $1 million invested. Otherwise, it just doesn't make sense, right? And that was the reason why we kept it. So it was a very conscious choice. To allow commingling and all, you have to get a CMS license, what we have. Most of the other providers have an FA license. It is much easier. FA license you can get in 2-3 months. This was a much stringent and much stricter process. But when we built it with the process. A very, very conscious choice, which was done. And it was a lot of thought, I would say a lot of effort, when we would have launched a year earlier if we had just done an FA license like some of the other guys do.
Yeah, and I think in my analysis, I actually see the fractional shares as a benefit. So I think this is really up to individual consumers or retail investors to decide, right? Because if you want these benefits that comes with the Syfe REIT plus portfolio, then that's a trade-off that you would have to make. But I'm not honestly too concerned about the credit risk and all, because you guys have a pretty solid, and the way you do the trust fund management and all is pretty solid to me. So I'm not too concerned about that. And I think, okay, this is slightly off the discussion, but I'm starting to see more providers starting to offer fractional shares as well. So there was this ad that I saw recently for a major brokerage in the US that's now starting to offer that. And I think, although fractional shares is still not it's not like mainstream yet, there could be a time in the very near future as we have more retail investors and younger investors coming in who just don't have that kind of big funds up front. Fractional it might just be the next trend. And if that happens, commingling is definitely going to be part of that, right?
I mean, Andy, but just for your knowledge, right, even when these brokers allow fractional ownership, the only way they can allow fractional ownership is they are commingling it.
Correct.
Right? Because so that's my point. So essentially, rather than, they can say it's yours, but actually they've commingled it, right? Because that's the only way. Because if this, as you said, if the stock market itself has 100 shares, minimum is a lot that trades. How can you trade, 10 shares? The only way is you commingle it with 90 from someone else, right? So
Yeah,
That's
correct. And for anyone who wants to replicate the Syfe REIT Plus portfolio, there is essentially no other way for them to do it except to do DIY, like what you say. And yeah, that's going to
well,
be
even
the huge
DIY
capital.
also, and then it's the licensing and everything. So yeah, it's tricky, and then the dividends and all, which I you know, as you said, I think just like the ability to reinvest dividends more than pays up for the fees, right? In many ways, right? So that's quite interesting.
Yeah, it's the convenience, and it's a good price to pay for convenience.
Yeah. It's cheaper and it's convenient. Yeah, let's put it that way. So yeah.
Okay. There's a couple of questions which are about investment horizon, and there's some people ask about 5 years, someone asked about 5 to 20, 15 to 20 years. What do you think is a good investment horizon in general, maybe, or maybe specifically when it's about REITs?
Don, you're the expert. Go for it.
Me.
Yeah.
I think the time horizon really depends on you, honestly. Because the question to ask, I would turn that question back and ask, how long do you think REITs would be a viable asset class? Do you think they will become stagnant? Do you think they will go up in value, like what has happened in Hong Kong? Right? We thought that Hong Kong property was expensive 10 years ago. Just look at where they are now. They've only gotten more and more expensive and more valuable. Or do you think that they could go to zero? Yeah. And I think real estate in Singapore, we're lucky because the political climate in Singapore actually is really favorable for real estate. And I mean, even with the Hong Kong protests, we're starting to see more foreign inflows of capital and they're coming into Singapore. Right.
I heard it was like a record, right? Like last month or something, some $62 billion or something came in deposit. And
exactly.
Those will come in the REITs also, right?
Exactly. And usually when they come in, they don't always go straight to the stock market, right? Some of them would choose to buy property instead because it could be part of legacy that they would want to pass on to their children or part of their business assets. So yeah, I think that's a really strong case for real estate. I am especially bullish on real estate for Singapore because of the political climate. I wouldn't say the same for every other country out there.
Yeah, it's a very, very good point. Yeah, and actually one question, I'm just somewhat linked to that. You know, I think somebody's asked again, so I'll just probably pick it up from here. The question from an attendee is that with the current REIT situation where it's possible that no income might be distributed to investors, is it worth to join the market now as we have to still pay other charges? What would your view on that be? I have my view, Don. What's your view on that?
Oh, you can go first.
Okay, I'll go first, right? So my view is that firstly, I think it's quite unlikely that you will have a zero, dividend scenario because I mean, somewhere REITs obviously want to also attract the right kind of audiences and people to be interested in investing them because eventually if they start giving zero dividends out, their subsequent raises will get impacted. Nobody really will be interested in them, right? So I don't think we'll have a setup of zero dividends. Yes, I agree that there might be a bit of a cut. I think the interesting thing, and sometimes I think what users forget is that, see, REITs is like, there are two parts of it. One is the actual capital, which increases and decreases. And one is the dividend, which, well, is on top of that, right? Typically, if a company is not really paying dividends, somewhere the asset itself is increasing, right? So I know when Maple recently said that, oh, we will decrease our, DRPU, they actually, it's not that they can't give it out, but all they have done is they've actually kept some to weather a tougher climate. And I actually think that is prudent fund management, right? Again, if you are here for a 2-month, 3-month horizon, you might get dividend or you might get low dividend, very possible. But if you are here for 18, 24-month horizon, right? I think with the new MAS ruling, they're anyway supposed to pay out 90% of the taxable incomes out. You will get that paid out, just the payout might get delayed, right? So definitely stay invested, right? I think, as I said, we always say the time in the market is much more important than timing the market, right? So if you're here, and typically, as I said, we generally as a platform are for people who are like mid to long term. I don't think there is like a perfect time, but the fact is at least that you are concerned about, I think they're well addressed. Yeah. Don, any further thoughts?
I think, I might be an investor in some of these REITs, but I am of the view that when a REIT is struggling, or not even struggling, when there are exceptional cases like what the times that we're living in now, I actually prefer if they hold dividend and if they hold it back rather than giving it to us.
Yeah, exactly, right. Because you get your dividend, but the REIT itself will start performing so poorly,
Yes,
right? Somewhere, right?
Exactly. Because I think for me, I don't just look at the dividend yield, right? You have to also think about the capital share price. So if because of the fact that they gave out the dividends and it was more than what they could afford to pay at that point, and investor confidence in them drops because of how their financial health deteriorates as a result, then the drop in share price could actually be worse than the dividend that you got in percentage gain. So I'm definitely supportive that they are starting to hold back or cut or even halt REITs the dividends entirely. But not just in REITs, I would also say in investing, right, this is the thing, there's gonna be risk that you would take. And you have to balance those risks. And if as an investor you will only go in when times are good, then you just need to know that your returns are also going to be very much different. So I'll use a few examples. In the last few months when the REIT market crashed so badly because of the March crash, right? And then that affected us as well. There were several REITs that were trading at really, really good valuation. For me, the problem then was that there was just so many great ones and not enough money to buy all. So you had to choose which one to put your money into instead of buying all of them, right? But I was monitoring them, and until as of yesterday or even today, some of those REITs that were on my watch list have actually already gone up by at least 30 to 50%.
Yeah.
In a short span of a few months.
Remarkable, right? I was looking at the recovery. It's absolutely remarkable, right, in that front, right?
Exactly. But if at that point in time you were so scared, you were not able to stomach the risk because you think, oh no, work from home, office REITs are going to die, I don't think they're going to survive, and you choose to stay out of the market, that's fine as well because we have to manage our own risk appetite. But then you would have missed out on this huge rally. So it's the same question now, right? Is it worth for us to join the market now with all the charges that we have to bear and that there's potentially no income that will be distributed this year? Maybe, but don't just forget, it's not just the dividend yield, there's also the share price increase.
Yeah, very true, very true. One question for you, Don, which I can see is someone's asking, what are the different, brokerages and robos you use for investing in local and overseas markets?
I actually use a lot. So I won't be endorsing any one specifically because at the end of the day, I think each brokerage and each robos have to fit into each investor's appetite and preferences. So, I might, I'll give you one example. I won't name which one, but I am actually I am using this brokerage that a lot of people are not a lot of people who are trading US stocks are using it. But I like it because first of all, it fits my preference of not having to put in all the money upfront and then buy when it comes, right? I prefer to buy and then pay up. So that brokerage allowed me to do that. And in exchange, I had to pay higher fees. But I thought that was worth it because the fact that I didn't have to transfer the money upfront meant that I could put the money elsewhere and let it generate the interest. So I pay a price for that. But if I tell you now what I use and then you think that, she's endorsing it, I'm going to use it straight away. Then if you don't understand the context, it doesn't fit you. You know what? It's a poor recommendation. So I'm not going to I'm not going to open up that can of worms. So I'll say that there are great brokerages out there. In fact, almost all brokerages are great. It's just which one is better for you. So you have to evaluate for yourself.
Yeah. All right. There's one easy one for me, which I'll answer, and then there's one for you, Don. So someone's just asked, what is the tracking error of the 100% REIT versus the iEdge S-REIT 20 index? The tracking error actually is really low. I think last when we checked, it was actually just about 48 basis points. So under 0.5%. So very, very, that means a 99.5% accuracy to the index, in other words. So I hope that answers your question. Don, what's your view on the merger of Capital and Mall Trust and Capital and Commercial? I'm sure you've answered this question 100 times by now.
I have to be honest, I actually haven't really looked at it in detail yet. Okay, I haven't had time to study it because I was too busy studying the US market the past few days ever since that announcement has been happening. But on a more qualitative side, without even going into the numbers yet, I think CMT and CCT merging might be a good move forward because it should allow them to synergize the REIT management. And at the same time, the commercial portfolio might probably have some negative sentiment during this period because of the whole view on office REITs. So retail, we all know is not going to die. Okay, everyone thought it was going to die for years, right? And then we realized they wouldn't because there's still a case to be had for retail. So I think combining those two industries that are having that kind of varying sentiment right now, it's actually a good move. So yeah, I actually think the merger is even better.
They'll actually end up becoming the single largest REIT, right, in Singapore. I think north of like $20 billion, like it'll be massive, right?
Yeah, exactly.
Yeah, so it's actually quite good because we've been, we've sometimes spoken to our counterparts as SGX about how that, impacts the index and all. And obviously they are at the real front of it. So it'll be quite exciting to actually, see it. All right.
Yeah. I'm just going to jump in and fill in one question on Facebook. So Hualing is asking, is SDIC applicable to Syfe? Why or why not?
Yeah, so as you know, it's SDIC you mentioned, right? The Singapore. Yeah, so if I'm not mistaken, SDIC is only eligible on deposits, like, bank deposits for that matter. REITs or even our global portfolio, as you know, that's an investment product. So it comes with, a set of risk attached to it, right? And obviously people take that risk for the much higher returns that they end up offering, right? So that's why SDIC is not really applicable. SDIC, I mean, as the name suggests, is Singapore Deposit Insurance, right? So yes, it's only for deposits, right? So you don't get much. You get like 0.1% return on it, maybe now even lesser. But of course, it's safeguarded from up to $75,000 as the case might be.
Dhruv, a question I have answered now a few times, but this keeps coming up, and I think it's something very relevant to answer, is about cost. Can you maybe share the slide which outlines the cost of the REIT Plus portfolio? I think that would be great.
Sure, why not, right? And I think some people have been asking questions about tracking errors and all also as like, hang on, yeah. Just bear with me. I shall quickly do this. Right. Okay. We good?
Yes.
Okay. Great. Yeah. So how we are, I'm going to avoid. So basically just one last, very important thing. The way how we are structured is that, right, we want to be completely transparent with our pricing, right? There's no trading, as in there's no entry, there is no exit. We are not like those pushy salespeople who are like, come on our platform because, we make money. We actually only make, it makes financial sense for us if you come and if you stay invested for a long duration of time. So we are basically building a platform where, we hope that you will actually be a part of Syfe for, years and decades to come, right? As you know, there's no minimum balance, there's unlimited rebalancing, and there's no exit charges. You can withdraw a small amount or large amount as the case might be, as much as you want, right? And in cases where we use ETF, it doesn't, let's say, apply for the 100% REITs portfolio. We obviously cherry pick and choose the most cost-effective ETFs as the case might be. So currently, we basically have 4 plans. The way how these plans actually get decided is from the minimum investment amount. Now, the interesting point to know is the way we decide this amount is a sum of all your portfolios. So if you have a REIT portfolio and a REIT with a risk management portfolio and a global portfolio, we'll combine all of that, right? So essentially, it's 4 plans, from blue to platinum, as you can see. The fees reduces. It's 65 basis points if you're under $20,000. Between $20,000 and $100,000, it's 50 basis points. And over $100,000, it actually falls to a very, very attractive 40 basis points. Platinum starts if you are a serious investor, $500,000 and above. Please feel to reach out to us, and we'll be happy to help. I think what's very interesting is that with our black and gold programs, you actually also have a dedicated advisor who comes for you. Well, in gold, you get a dedicated advisor. In black, you get a team of financial advisors. The advantage of this is, of course, they can help you ask questions. Like a lot of people I see ask how, someone asked what part of my portfolio should I allocate, right? Or is this the right time, so on and so forth. So everything that's relevant to you, these financial advice, it's included, in your service, something worth addressing to. Also, if you are in a black or above program, you get a complimentary, financial planning session, which some users, especially, those who are relatively new to markets, actually find very, very, useful. So this, in a nutshell, actually summarizes, our cost. Any questions, Seb, on this? Because I saw some questions earlier, but I think because you're tracking, I think you're better off.
Yeah, no, I think that explains, and I think most questions were exactly around that. So there is basically 3 tiers, and this is this management fee, and these are the only charges you have when you're investing in a REIT. Those questions. There is one question which I would like to give to Don, which you mentioned earlier, that you are bullish on the Singapore REIT market. And I think that's already the answer to one of the questions which are still there. Do you have any view on US REITs? Would you recommend them to have them as part of your portfolio?
Okay, I don't really understand the question, because US REIT can mean US listed REITs or REITs listed in Singapore that have US exposure. So that's like Manulife and a few others, right? And I'm not the biggest fan of those, because correct me if I'm wrong, but I think from my very brief, it's been a while since I revisited the research, but I think there was like some taxation that they just didn't have those benefits compared to the local REITs, I think. And but at the end of the day, whether or not the taxation is, because I can't confirm that. It's been a while since I last looked at a US Singapore listed REIT. But at the same time, there's also the Forex issue, right? So with US REITs, I don't see the strong case compared to if I want to look at US REITs, right, then I am more inclined to choose between US REITs and US stocks. So yeah, I think in terms of the REIT market, I'm a lot more interested for Singapore, for Hong Kong, although Hong Kong is changing. So I don't know if I am still super bullish on that, because you have to see what the US is going to do to Hong Kong, right? They're threatening to strip them of all the privileges and all, so that might affect them negatively. But I think in terms of real estate, right, I'm more bullish on real estate in Singapore, in maybe Australia. I am still on the fence on that, but a lot of REIT managers that I spoke with are quite bullish. So I'm still going to leave that as an open-ended thing. And also China. But the listed REITs in Singapore that give us exposure in China are not much either. And I think most of them are in the retail space. So there's not a lot of opportunity for us to write on there. But you know, who knows? Things might change, right? Maybe China will make Hong Kong the next REIT market. Maybe China will set up their own REIT market, or maybe they'll come to Singapore if the Singapore government is great at attracting them over. We don't know. So I'll just leave it open, and I would adapt accordingly. But adding on to that question, so I think there's also one question related to it, which is REITs outperforming US equities at the moment. I'll answer this question because it's very much related, or US related, right? And the answer is, it depends on which ones you're looking at. If you're comparing REITs to, say, your Facebook, Google, Amazon, Shopify, Zoom, and all the tech stocks, right? Then obviously no, because you know the sharp rally in all these huge tech stocks has just been really insane. Yeah. But if you look at, for example, REITs and some of the other US retail companies, or even in logistics, in chemicals, in manufacturing, in automotive, in airline, they haven't really recovered much. And depending on how, if you're looking at REITs market on the whole, or even individual REITs compared to them, right, we have actually been doing pretty well. Yeah, thanks to the rally yesterday. I wouldn't be able to say this if it wasn't for the rally yesterday. But yeah, the rally was just crazy, and that So if you compare it now, some REITs have actually done better in US equity. So at the same, at the end of the day, I say you have to decide whether or not you're going to do like if you're going to do a basket, right? Then you should be comparing to the S&P 500 and not like individual equity. It doesn't really make sense to compare REITs to individual equities. They should take up a slightly different portion of your asset allocation. Yeah, I agree.
Okay, thank you for that answer. I would like to combine a couple of questions, and there are questions regarding DCA, or dollar cost averaging, versus lump sum investments, as well as there are question, is it possible to invest monthly over a 15 or 20 year period of time without ever worrying about rebalancing? Maybe Dhruv, you can elaborate a little bit about how, are there any restrictions on monthly, weekly, or anything deposits? And maybe both of you maybe want to share your opinion regarding DCA or lump sum investments.
Sure. Yeah, so regarding the top-ups, right, as you know, as me and Don were talking about earlier, you can actually add as little or as much as you want. I don't really see a big value of you trying to put a small clip every day or every week also. I think monthly is fine because it's understood, like many of us probably are salaried and, you know, we have salary income, which we have to place out. But I think making it over granular, you know, like we have this one customer, I think who has invested with us without fail every day, right? Every day he invests, right? And small kids, I think that's a little, overboard. I mean, thank you, because, it sets a new record for us internally, maximum number of transactions per client. To answer your question, yes, you can do multiple times a day, multiple times a month, as much. As I said, the beauty is there's no entry and exit charge. So we will only look at your overall asset value and we will charge you a fee on that. So this fee also, which by the way, you're seeing on your screen, this is of your, net asset value, which is, computed on a monthly basis, right? So let's say you pay, like, you're in the black and you pay 0.5% PA. So it's per annum. So if you just come and let's say if you're only there for a month, you will only pay for 1 month. So 0.5 divided by 12, as the case might be. So the answer is yes, you can do it as much as you want for 20 or 30 years. Great. We've got our first 20-year customer though. That's great, Seb. Like, isn't that very nice? Yeah. Don, I'll leave it with you, and then I'll give my thoughts. What's your take on lump sum versus DCA? Because it's a very interesting topic, right? What's your view on DCA versus lump sum?
I think it depends on what works for you. So I repeat this a lot of time, but it's really because I think a lot of investors are looking for like one flat answer, right? Can buy or cannot buy, do this or do that, but reality in investment is not that simple, because DCA is good for some types of people, whereas lump sum investing is better for others. So let me break that down. If you want a very disciplined approach that takes away any emotions involved, then a DCA approach would be good, and you can opt to do it at any frequency that you want, be it once every month, once every week, or once every day is a bit extreme, but maybe.
I was surprised also, right?
Yeah, that's interesting. I've never heard of that, but yeah, maybe once a month, once a quarter, or maybe even once every half a year. That's fine. If you want to do lump sum, it could be because you intend to invest your bonus. Right, so maybe this portfolio is going to be that portfolio where you invest your year-end bonus instead of spending it, and then you're going to see how that fares. So then that would be like a lump sum perhaps at the end of the year or at the beginning. So at the end of the day, it depends. If you don't have time, but you want to remain invested at all time, then it would be good to set up a DCA approach. If you want to have a little bit more control and you want to attempt to time, and I'll focus on the word attempt because no one can do it well consistently, then you can go for the lump sum approach. For myself, I'll be very upfront. I usually recommend people to choose their own, and I realize for a lot of people, DCA will work better given their personality and a lot of other qualitative factors combined. For myself, I actually do lump sum. But the reason why is because we value liquidity a lot. And I spend a lot of time analyzing stocks and the market. So it is only natural that I go in a lot more given that amount of work that I put in. So just a case in point, right? Not just in terms of REITs, but let's just look at investment shares, stocks as a whole. I think the amount I invested last year was pretty mediocre compared to how much I pumped into the market in February, March, April and May. In the last few months itself, I put in so much more in the market that I have compared to the entire of last year, because the market went down, valuations became very attractive. So it made more sense that I would put in a lot more. But if I had done a regular DCA approach, then I may not have had that liquidity to just pump in that much. And as a result of that, my portfolio for those that were born, especially really close to the bottom, has gone up by a lot. But at the same time, I also lose out because I didn't buy in that much during 2019, right? And we all know what happened in 2019. REITs went up by a lot. There was a huge rally. And I missed out on that rally because I was so focused on valuations, and I felt that I just didn't feel comfortable buying in. And then when the crash happened, who knew that would happen, right? No one expected a virus. And in the early stage, they were all saying it's just a flu, it's going to go away. And then we realized it wasn't. So no one expected or could have seen this coming. And when the market crashed, then on hindsight, it was good that I didn't put in that much money last year. But until the market crashed, I was actually spending a lot of time beating myself up and, I missed the rally. Why? So you have to manage that. I think at the end of the day, investing is all about your discipline. It's about your psychology. It's about how much homework and research you're willing to put in. And if you don't have time and energy for that because maybe you're trying to climb the career ladder, then a DCA approach would work fine.
Yeah. In fact, thanks for that. I'll give you a personal views on. I'll just add some statistic points. This was a very common question which gets asked, especially for our global portfolios, but I think the same applies to the REIT portfolio as well. So we were running numbers and we tried to say that does a lump sum strategy or does a DCA strategy beat in terms of performance? So I completely agree that, it should be individualized and you should see if lump sum works better or DCA works. Our recommendation is if you do have the funds and if you don't need them, then lump sum is always better. And what we did was, this is not just an opinion. We actually ran numbers over a 2-year period, I think for the last almost 15 or 20 years. And if you had invested for any 2-year period, let's say you enter and we keep for 2 years versus, let's say, putting monthly for the next 24 months, in 77% cases, i.e. 3 out of 4 cases, lump sum beat DCA. So unless you need the money, like always and always go for lump sum, right? If you need the money, or let's say you're salaried and you don't have the kind of money, it's a different story. Then you really can't do lump sum. But let's say if you have an option to do between the two, always and always do lump sum. Of course, the presumption is you're invested for a long duration of time, and there's volatility you have to write down.
Mm-hmm.
Yeah.
Exactly.
Seb, back to you. You're on mute, Seb.
Yeah, sorry. There is a question by Kevin, and he asked, and I think, yeah, we have a couple of minutes left, so I think we should be able to answer the majority of questions. Kevin is asking, if I have an STI investment, is it equivalent to investing REITs, as I know STI also has a REIT component?
It's not exactly the same, right? Because STI also have a lot of the banks. It also has, what else do you have? It used to have Noble, but not anymore. And it used to have Comfort, right? I think Comfort was recently taken off that list, right? I think also, what else? Stats. Although with Stats going up now, I don't know if they're going to add Stats back to this.
It has Singapore Airlines also, right?
Yeah, so the STI is more than just REITs, right? So the question is, how I see Syfe REIT Plus fitting in is that if you want to create a portfolio, and if you want an asset allocation scheme of things, then what are you doing on the real estate portfolio? And for me, because I only own the house that I stay in, and it's not an investment property, we hope to have one eventually, but at this stage we don't. So Syfe REIT Plus is actually that way to go into that asset class, and I don't have to be too bothered about actively picking, because I feel it's more rewarding to actively pick the growth stocks in the US or undervalued stocks in Singapore, rather than trying to cherry pick the REITs, because almost all the REITs have been performing pretty well, right?
Yeah,
and the ones that I have picked have not always done very well because I didn't react in time. So I see a very strong case to be had for the REIT portfolio, and you can't compare that to STI. Yeah, because STI you're buying to the entire Singapore market. The STI equivalent comparison should be your Hong Kong, your Hang Seng Index, or your S&P 500.
S&P. But S&P has done far better than STI. STI has falling, right, in their performance, right, in the last, I guess, years now. So,
but that's kind of also because the S&P 500 is largely made out of the large tech stock now, right? If you
now yes, but like after the rally and all that, right? It's
correct.
been quite interesting. But yeah, I mean, it's STI has been a bit of a tricky situation. Yeah.
Yeah.
Dhruv, 2 short questions for you. One is rather a feedback, but I have seen it multiple times, so I want to bring it up. A few people ask actually if we can show the average cost per unit in our dashboard, and I think is a fair point.
Yeah, we actually show it in our the month end when we send the summary report.
The account statement
down and we show it. We did not want to show it in the dashboard because we thought that is too granular level of detail. But we'll take that feedback and we'll see if we can work on improving our designs to actually replicate that. But just FYI, you get a month-end report every month. I think the report of May should be available in the next few days out, which actually gives a granular breakdown of your purchase price as the case might be.
Right, thank you.
It's great to hear that you're open to adding that in. I think I don't really see the need for it personally, but I think it's great to help. It would help psychologically for many investors because they do get pretty affected by this part, right?
It was. I mean, it's going to be all in like decimals and all that. So we actually tried to build a few. It was just getting too cumbersome, and we also want to give a user experience, but. If a couple people are asking, customers always right. So we'll hear you. We'll try to see what we can do out there.
Okay. Yeah, and for everyone who wants to know right now, like we basically show the total amount as well as the number of units. So if you want to just divide the total amount by the units you will have,
Okay.
the average buying price as well.
Yeah.
Before we wrap up, maybe two super short questions. One, does the tracking error, and I know you answered this question before, but does it include or exclude the management fees?
I don't think that's a right question, because you are comparing index to an index, right? So let's say that you are not coming on Syfe and you were trying the index from some other way, you would have had the fees for that also. So tracking error is always done index to index. So I don't think that's the right question to ask. Yeah.
Correct. Good. And then someone is asking, and this is for the global portfolio, which I want to also take the chance to tell our viewers about our next week's seminar, where we not only focus on REIT Plus, but give a bit more of an overview of the different portfolios. So please check out our next week's webinar called Meet Syfe, where we give a little bit of an overview about all the different portfolios we offer. But the question is, and sorry, yes, before you go to that, maybe also quickly on the promo code, please feel free to answer the questionnaire which we ask for very short feedback only, and I will ask Dhruv to show the QR code. And at the end of the questionnaire, there is a promo code which you get up to $100 if you sign up and invest with Syfe. So the last question is, like, is there an option for the global portfolios to switch off RE similar to what you can do on REIT Plus?
Yeah, I mean, it's how do I say, right? I actually think it's a very bad idea to switch off RE, because, you know, people have seen a few months and I think there's a knee-jerk reaction to it. We are working on a variation which will probably address what you are, looking for. It is sooner than you think. Let's put it, before the end of this month, there'll be a variation out there. So we've taken the feedback. We always listen to our consumers, and there might be a variation, but I would always suggest that, when you're looking about RE, like, think of it as a medium to long-term play. And I think looking at a 3 or 4 month duration might be very low. Having said that, RE has still beaten all benchmarks, right? I think some people have raised concerns about the rally, which has happened in April and May. Our view is that the volatility is still high and RE is trying to manage risk, right? So probably something we can address more in the subsequent seminars, but something is out in the works, which should be out before the end of this month, which should actually address your needs. So indirectly, the answer is yes, right? So
can I jump in real quick and take
Sure.
the last two questions so we can wrap up?
Sure.
For someone's asking, for beginners, which portfolio would you recommend? There is actually that questionnaire, that profile thing when you sign up. So I think just go ahead and ask that question, because there is no straightforward answer to which portfolio. There are different types of beginners, right? So you have to see, there are beginners who are like super risk adverse, and those who want like 100% weightage to the on risk alone and no bonds. So you have to see how you fare on that questionnaire, and then it will suggest the portfolio that's more suitable. And for the iQuadrant one, okay, so this is a timely question, because I did a really long post on iQuadrant. You can go ahead to my blog to read it, but this is super different, right? I'll just name upfront. For iQuadrant, you have to go and pay for a course, and it costs like about $3,000, high $2,000 or $3,000, right?
Yeah.
With Syfe, you can just use that $3,000 if you had that money to begin with upfront to just immediately invest. You don't even need to pay anything to learn. Secondly, for iQuadrant, they focus a lot on buying and owning the actual property. So the formula, I'm not going to talk about the formula here, because this is not about them. You can go ahead and read the post that I wrote on my blog, but it is about owning the actual physical real estate itself, as compared to REIT stocks or even Syfe REIT Plus, which is the shares of the REITs which are managed by the own REITs manager. So if you go down the iQuadrant route, right, you actually have to deal with the tenants yourself. You can hire a property agent to help you. Then yeah, go ahead and pay the property agent the commission and the amount to help you manage that tenant if you want to. But if you look at what the students of iQuadrant were going through during this period, with tenants not being able to pay up, asking for rebates, you would have to manage that yourself. compared to if you just simply invested in a industrial REIT or a retail REIT, and you don't have to deal with any of that because it's Capital Land who deals with that for you. It's Ascenders who deals with that for you. So it's super different.
Okay, very good. Great.
All right, so yeah, we've come to an end. Thank you everyone for joining us on a Thursday night, and we overran by a bit, but I think it has been a really great discussion, lots of good questions, and we hope that this was useful to you guys. If you want to read more about Syfe, please go ahead and read on their website. They have lots of data on the REIT portfolio as well. You want to check the component, you can check the iEdge index. If you want to understand a little bit more on the 3 different approaches that I shared on how to invest in REITs, it doesn't mean you have to choose a Syfe REIT Plus model, but it's a great model to go for, honestly speaking. So you can go ahead and read my blog post, read Syfe's website, speak to anyone from Syfe, and get all your questions answered. Remember, never invest until you know what you're investing in, right? And the people at Syfe are happy to help you. So we're really thankful that you joined us today, and thanks guys for having me. Thank you so much.
It was lovely. I think I really enjoyed the session, right? I think it was very interactive, and we tried a new format with very less slides, and I actually enjoyed it much more. Also, I don't feel I have a parched throat anymore. So thank you so much for chipping in on all those answers. Was really good. And thank you everyone for joining us today. We're sorry if we couldn't answer some of your questions. We've run out of time, but feel free to drop an email at support@syfe.com, and we'll be happy to answer. And if there are questions for Dawn, we'll forward it to her and she'll come back to you. So.
or just send it straight to me on Instagram or on Facebook.
Yeah, why not? Great.
Yeah. All right, thanks guys. Well, Syfe is gonna have a few other webinars coming up as well. So yeah, please stay tuned to them. If you have more questions on other Syfe products, because we didn't talk about that today, you can always speak to them at a later stage or at another webinar to get those questions answered.
Yeah, I mean, we started off with the global product, right? But recently people know us more for REIT, so we'll be talking a bit more on the global at some point. So all is good. Thank you all. Thanks, Sebastian, for hosting.
Thank you.
Thank you. Goodbye. Have a good evening.
Bye.
Bye.
Thank you.
Bye.